Good afternoon. So, for the month of January, and sorry I'm posting this late, but for the month of January, my first $1,000, after screening about 12,000 companies, which sounds impressive, but actually took like 5 minutes, thanks to, pushing buttons with screeners. I'll actually explain that later. But anyway, my the top 2 picks for the month of January, and when I say picks, I don't mean like a hot stock pick. I mean these 2 companies are probably going to be at the top of my list for the next 10 years. But starting in January, I am buying 2 companies. One you might have heard of, Southwest Airlines, which also ironically happens to be owned by Warren Buffett. And when you start screening companies, and the same companies that come on your list are the companies you see top investment managers making, like Warren Buffett, Ray Dalio, guys like that, chances are you're at least not wrong, and you at least won't lose a whole lot of money. So we're gonna go with it. And then the other one that isn't as well known, but they came up on the same list, is a much smaller company called Hennessy Advisors, and they are pretty much on the same playing field as a company like BlackRock. And if you don't know what that is, these are basically investment firms. They have specialized investment vehicles and products that they sell to their clients, and that's pretty much the simple math of it. And I'll go into the 4 metrics that I really use to screen these companies, but yeah, those are the 2 companies that I'm buying. And to explain how that process works, I will talk to you in a few hours. And I'm back. Actually just got home. So yeah, let's talk about, alright, Hennessy Advisors. So the metrics that I really look for, and how I come up with a list of about, lately it's been about 150 companies out of 12,000, if that tells you anything. It's actually really simple. It's either very low to no debt at all, which means that if you were screening for it, that would be a debt to equity ratio of 1, or actually less than 1 or 0. And then the other things, which are also really, really important, are the dividend growth rate. For example, there may be a company that's paying 12% today and a company that's paying 2% today, but in 5 years, if the company that was paying 2% was well managed and had a growth rate high enough, then that company would be paying you more than had you had bought the 10 or 12% dividend yield today that they probably couldn't afford in the first place. And so the other thing is, well, how do you know what a company can really afford? Well, it's pretty simple. You look at their earnings and then you look at their payout ratio. And so if a company is paying out, I would say at most 60% or more of their earnings, then that's probably a red flag that it's going to be difficult for them to really grow going forward, either to grow their dividends or to grow their own earnings, because you have to reinvest in a business to make it grow. And then, so I would say a payout ratio of 50% or less, and then the last metric. Sorry, I had to take my glasses off. But yeah, no, the most important metric really to me though is the debt. If you can run a company and it can grow, and you can pay to your shareholders, and you can reinvest in your company, and you don't need debt to do that, you're running a very successful company. And then the final metric is the return on assets. So again, if your return on assets is solid, you're growing the company, and you don't need debt. One of my favorite quotes about debt is that if you're smart, you don't need it, and if you're dumb, you have no business using it. And so both these companies, both Southwest and Hennessy Advisors, meet that requirement. And one thing I want to point out that is really cool, so Hennessy Advisors is a very small company, relatively speaking, in the stock market world, we'll call it. Really anything less than $1 billion is just extremely small, even though that seems like a lot of money. But a company with a market cap like Hennessy has
It's only, I think today it was around maybe $80 million. And so it's very risky because a small company like that, if they lose enough clients, very quickly can become can go from $10 a share to $1 a share. But it's been managed well. It's been managed well for well over a decade, and so I feel pretty safe and confident in investing in it. And the hope with a company like that, so it's essentially competing on a playing field that BlackRock is, and that's difficult. But if they can pull it off, and I think they can, the returns could be pretty substantial. Because you take a company like BlackRock. Okay, BlackRock has almost, actually over $6 trillion under management, right? Well, for them to, let's say, go up by 10 would mean that they would have to have $60 trillion under management. Basically, they would have to manage all the money that's invested in the stock market across the globe, or across the United States. So that's very difficult to do. It's not unthinkable to think that you could go, though, from a company like Hennessy with $4 billion of assets under management to go to maybe 10 or 20, and for them to then have a market cap to go from 80 million to a billion or even 10 billion, and that's when the returns really compound and you really see your money grow. So that's the hope with that one. The other, Southwest Airlines. So what's really cool about Southwest compared to their competitors is that most airlines are very highly leveraged. Southwest is not. They actually have very low debt levels. And so what puts them in a very unique position in that industry is that if that industry, and it always does at some point, goes through a rough patch, then they're in a position to where, one, they can buy out some of their competitors who would probably go bankrupt, and get their assets for what you call pennies on the dollar. And then the other thing too is they've managed to run a very successful airline based on very low costs. And so if that industry consolidates, which it may in the next couple of years, then they could buy out some of their competitors, raise their prices just a little bit, and be in a really solid position, and maybe, and I would even dare say, dominate the airline industry. So those are kind of the best case scenarios. Worst case, and it is very likely, I have looked at economic data, and I mean, it's not the greatest in the world, and probably not the what people would call the best time to invest. But the reality is, I'm going to invest $1,000 a month, no matter what's going on, and I'm gonna look for the best assets that I can buy. And bar none, I do think that those two were the best for this month, and they probably will be for a little while. So again, not that exciting, not that flashy, but I really do believe that this is how you get returns that beat the market. And for these guys that day trade and trade options and do all this fancy stuff that sounds cool, that makes you think you can have 300% in 3 months, well, you can also lose everything you've got in 2 days doing that kind of stuff. And it's not, and trust me, I've looked at it, I've run the numbers, I've crunched data like crazy, but that isn't sustainable. So if it was, then people on fours would be doing that. So, but that's all I have for today.